A lot of young people feel like the housing market is broken. They're working full time, they're saving, and they're doing what they were told would lead them to home ownership, and yet buying a home still feels completely out of reach. This isn't because young people suddenly stop trying or that they're lazy. It's because for a long time, home prices and wages moved roughly together. Homes were expensive, but not this expensive relative to income. Over the last few decades, especially since the early 2000s, that relationship changed. Home prices kept compounding upwards while wages grew much more slowly. That gap matters more than anything else. When homes cost 3 or 4 times your income, ownership is hard, but it's achievable. When homes cost 7, 8, or 10 times your income, ownership becomes impossible even for financially responsible people. And this is where most of the pressure starts. When home prices rise that much, the problem isn't just the monthly payments, it's the down payment. A 5 or 10% down payment sounds reasonable until home prices triple. Because 10% on a $250,000 home is $25,000. But 10% on a $750,000 home is $75,000. That's not about budgeting better, it's about time. And this is where wealth, not income, starts to matter. A lot of the economic data today consistently shows that many first-time buyers rely on help from family or friends, whether that's gifts, inheritance, or living rent-free while saving. If you don't have that support, you're competing against people who do, even if your salary is solid. Now add mortgage rates on top of that. When rates rise, it doesn't just make homes more expensive, it changes who qualifies to buy a home at all. Banks lend based on income and debt ratios. When rates go up, the same income qualifies for a much smaller loan. That hits young buyers the hardest because incomes are already low early in their careers, their job history is shorter, and savings are much smaller. So even if prices stop rising, higher rates can still push people out of the market. And affordability, it's not just about price, it's about your ability to get financing. At the same time, a lot of young people are carrying massive amounts of student debt. Not everyone, but enough people that it matters. Student loans massively affect how much a bank will lend, even if payments feel manageable. 2 people can earn the same salary, but the one with student debt often qualifies for less of a loan. That doesn't mean homeownership is impossible, it means it keeps getting delayed. And that delay matters. Then there's the supply side. After the 2008 financial crisis, home building slowed dramatically. In many places, it never recovered. Zoning restrictions, long approval timelines, higher construction costs, and limited land near jobs all made it harder to add housing where people actually want to live. When supply doesn't keep up with population and job growth, prices rise faster than incomes. And the people most affected are first-time buyers. Meanwhile, old homeowners benefited from timing. Many people bought when prices were lower relative to their income. They rode decades of appreciation, they refinanced into very low mortgage rates, and that gives them a lot more equity, flexibility, and staying power. Young buyers aren't just competing with other first-time buyers, they're competing with accumulated equity and decades of compounding. That's not about fairness, it's about timing. And all of this gets reinforced by rent. As home ownership gets pushed further out, people rent longer, but rising rents make it harder to save for a down payment. So you end up in this loop where higher rent equals less saving, and less saving delays home ownership. And delayed home ownership leaves you missing years of appreciation. Even disciplined savers right now feel stuck when housing costs absorb a growing share of their income. This is also why the idea of a starter home feels outdated. Many of the smaller entry-level homes that used to be affordable, like townhouses, appreciated significantly. And a lot of new construction builds, they target higher price points because that's where the margins are. So entry-level supply shrank right as demand from young buyers grew. And when you put all of this together, the picture becomes clear. Young people aren't locked out because they don't work hard enough. They're locked out because prices rose much faster than wages, down payments grew faster than savings, and rents raised qualification thresholds. And the supply of homes dropped massively. This doesn't mean that young people will never buy homes. It usually means they're buying later, they're buying smaller, they're buying farther from job centers, or they're buying with dual incomes. But delaying that time where you buy a home matters because time is one of the most powerful factors in building wealth, especially from your home. The real takeaway from this video was this: the housing market didn't suddenly become hostile to young people. It became more expensive than incomes could adjust. And once you understand that, the frustration people feel starts to make a lot more sense.